balance sheet, okay, and how the QE policy is going to affect the size, okay, the size of the balance sheet, the value, especially of the asset. All right, so all about the retained earning. All about the retained earnings. How much money are we going to preserve? Okay, how much money are we, since if we make one 10 say we make the another 10 million this year. Okay, so how much should we keep in our as the return earning? So let me give you a quick example. Okay, if company A made 10 million last year, should they retain all the 10 million here, or paid out as a dividend? All 10 million to pay out. Both are not very possible. Not very possible. Why? Because if you pay out, you cannot keep money, keep capital for more investment. Okay? But if you put all the 10 million in the continuing investment, the stockholder, they will object. Okay, they complain in the meeting. Okay, so the policy, okay, whether the capital budgeting policy or the dividend policy, they have to be in accordance with the capital budget. Okay. So let me give you a quick example for this. Okay, making 10 million, actually, and a company has a new investment, several new investments. Project to evaluate. Say, case X, Y, and Z with the budget say 2 million, 3 million, and 4 million. Okay, and the rate of return. In the future, we will use internal rate of return, but now we just use rate of return. Is estimated to be 6% or 6% also. Okay, but this one is 4%. Let me change a figure, change the number here from 2 to 5, sorry. Okay? Okay. So, now the company required rate or return is 5%. Plus the debt ratio, debt to equity ratio. Is set to be 1/1, to be 1/1. That means it could be 100%. That means if you have 1 million equity, you can raise 1 million debt. So my question is, how much? More debt to be raised, and how much dividend to be paid out. So this is the triangle balance, okay, of capital budgeting policy. Leverage, okay, leveraging policy, and the dividend policy. Okay? So let's look at the capital budgeting. This is the capital budget. The required rate is 5%. And for case X is 6%, which is greater than 5%. So we would accept this one. For case Y, also greater than 5%, we also accept this one. But for case Z is less than 5%, so we have to abandon this Okay, we will not accept case Z. So we will need to, for the next year, our capital budgeting, we have to come up with, we have to raise 8 million for capital investment. Company A for next year. $8 million capital for investment, for new investment. However, if we already made 10 million next year, we can use the whole 10 million because we just need 8 million, right? So we can have 2 million surplus to pay out as the dividend, and we use the 8 million. However, since our debt equity ratio of our debt policy is 1/1, that means for this 8 million can be from debt, can be raised from debt and equity. 4 million and equity. Okay, so this is very clear. Okay, so we need to raise debt. Okay, and then with this equity 4 million from what we earn. Next year. Okay, so how much is left? How much is that? So we earn 10, we use 4. Okay, is 6 million. What is the 6 million doing? You can pay out as dividend. Can be, no, you can not necessarily all. Can be paid out as dividend. So also, maybe you can also split into another portion of the retained earning as well. Okay? Or to pay out all of this. Okay, so this is the dividend policy. This is capital budgeting policy. And this is the leveraging policy. So 3 policies, triangle, they need to be balanced. Okay, so this is dividend policy. And this is leveraging policy. According to our leveraging policy, we are going to raise the other half as the debt. and this is capital budgeting policy. Okay? So whether if we want to put more money in our return earning, up to how much we are going to pay out here. Okay, maybe no, because we already used 4 million as the new investment. So if you do not pay out this much, the stockholder, they will object. They will go to the board meeting for protection. Okay, with this balance that we will have money on the project looks profitable. Okay, we also addict with our consistent debt ratio, and we also take care of our stockholders because they are our investors. All right. So these are three different major subjects on the financial statement, on financial management. Okay, so let's move to another statement. Let's move to another statement, which is income statement. Let me do it very quick, because some of you did not take accounting before. But this is important for us to know how to do the valuation, how to make investment decisions. So we have to be able to understand the financial statement. So the next is income statement. We call it 损益表. So it's different from balance sheet. Balance sheet is accumulative. So at the end of, say, December, okay, December 31, okay, then we accumulated, we sum up our assets and our liabilities and equities, and then we see the accumulated numbers. And for the income statement is the yearly statement, okay, from January 1st to December. Okay, this is a yearly, usually yearly, or quarterly. So we start from the sales. Okay, we sell so much, and then we deduct the cost of goods sold. Deduct the cost. Right? And then we deduct the expenses. Okay, maybe some from maintenance, okay, from salaries, okay, and of course here, including depreciation. Because this is a nominal, okay, of course not cash, but nominal expenses, because with this we are going to find the taxable income. Okay, so with all the deduction from the sales, we call it earnings before interest and taxes. EBIT, you heard of it. 息前税前盈余. Right? You heard of EBIT before. And then what's to deduct? Then what's next? What? Interest. Yes, you have to pay to the debtor. Okay? Then this is earnings before taxes. EBT. Then we deduct the taxes. Is earnings after this is after taxes. We call it EAT. Earnings after taxes. Okay, so if you are a stock investor, what you want to look is earnings after tax. But this is a overall number. Okay, with big companies, they have more earnings. With smaller companies, they have, of course, less earnings. So, what for an individual investor or stockholder, they look at the share per unit. So divided by number of shares. Number of shares. We call it earnings per share. EPS. This is very important. Because for an individual stockholder or investor, what they want to look is the performance, okay, of the company. However, which one you want to look at? Of course, earnings. So we look at the after-tax earnings. But for my share, okay, I am supposed to generate, you are supposed to pay me, okay, the company, as we said, pay the dividend. Okay, how much dividend you are going to pay to the shareholder per share, each share. So we want to look at earning after tax divided by the shares, stock, outstanding stocks, number of outstanding stocks, and which is earnings per share. And then with this, what's next? With this, we wanna find the fundamental value. So back to our original. I remember first or second class doing the remote teaching. Remember? So we do the fundamental value analysis. So our value, VF here, fundamental value, will be using the EPS divided by the rate of return, our required rate. Okay, so why I highlight the importance of the EPS is because we are going to use this number as the future income, constant income. Not necessarily constant, but maybe stable, supposedly. Okay, and divided by our own required rate of return. And this is our fundamental value. And of course, we are going to compare with the market price. So this is the direct capitalization. As you learned from the appraisal course. Okay, so this is the basic analysis. Okay, from the income statement. Okay, then using the result of the income statement, earnings per share. Then find the fundamental value. And then you can do the investment analysis or decision making. All right? So if you ask some investors in the stock market, you ask him, hey, what is the stock you've been investing? Okay, and he or she told you, hey, I invested A company, B company, C company. Okay, and then you continue. What are their earnings per share? If that holder, if that investor could not answer you this question, okay, he or she did not know the earnings per share for those stocks he is investing, then he is doing a very risky investment because he didn't know the EPS, means he did not know the fundamental value. And without knowing the fundamental value, how can he put money? How can he compare with this, with the market price? Then make profit in the future. He was doing the gamble. Okay, we will continue this after we introduce the financial calculator. So don't hurry. Okay, so this is the income statement to find the earnings after tax earnings. Okay, so this is the second statement. Okay, after that second financial statement, you need to understand or to develop. Okay, How about the third? The third is cash flow statement. This means we want to find the after-tax cash flow. After-tax cash flow. However, cash flow statement is similar to income statement. They are just income versus outflow, inflow versus outflow, deduct the outflow. So maybe we can just take a shortcut to see, hey, this is sales. If this is cash, we just keep it. This is cost, if this is just cash, keep it. And then, if all of these are just cash, maybe it's the same, right? And then maybe with some items not cash, we just make some adjustment. So, in practice, for accounting firms, usually if they just want to find the after-tax cash flow, all they do usually is what? Every item is similar, except depreciation, not cash outflow, right? So since depreciation is not cash outflow, so they just use the after-tax earning and then deduct this one. Earning after tax. So this one with this one, all the others are cash except the depreciation. So since this is not a cash, so they have to add this one back, right? Because you did not get your pocket. Okay, get the cash out of your pocket as a depreciation, right? So you deduct this one, you have to add it back to here. Plus depreciation. So we call this as an indirect approach to find the after-tax cash flow. And this is very common practice, common usage in the CPA firm, accounting firm, to find just after-tax cash flow, because it's easy and quick. Okay. However, for real estate analysis, we want to come up with our own cash flow statement. Okay, because for real estate investment, we are worried about the liquidity risk. And real estate, in a lot of situations, especially during the financial crisis, the liquidity is very, very, very low. Okay, and a lot of companies, they might go bankrupt just because of the liquidity issue. So for real estate analysis, we tend to generate our own cash flow statement with direct approach. Okay, but since today we are going to introduce financial calculator, since you have it now, so we are going to briefly introduce the operation. So we will leave the direct approach of the cash flow analysis to next week. Okay, so for our next hour, we will introduce the operation of financial calculator. Okay. So far, you have any questions on this hour and the previous hour? About the 缩表, okay, shrinkage of the balance sheet. Okay, it has to do with the C's of the QE policy, together with the dividend policy, the capital budgeting policy. Okay? No other questions? 资本公积 preferred stock. Okay? Then take a 10 minutes break and then come back with your calculator.